What's up everybody, Investing Club here, back with another video. In this video I'm going to take you through a few stocks that I'm keeping an eye on for the month of February. In this video I'm going to take you through some of the stocks I'm keeping an eye on for the month of February. And before I start, I'm not a financial advisor. This is not financial advice, this is for entertainment purposes only. And even though I'll be showing you these stocks, this is not me telling you that you should run out and buy them. I own a couple of these stocks, but I don't own all of them. And all I'm trying to do in this video is suggest stocks that have the potential to be undervalued based on the historical information I'm about to show you. So let's get right into it. Okay, for the first stock starting out, we have Bank OZK. That is ticker symbol OZK. And this company is a small regional bank, started out in Arkansas and is now spread through the lower eastern region of the United States. And there are quite a few things that make this a potentially attractive investment opportunity. So the website I'm on right now is called Fast Graphs, and I use this website a lot for my investing research, and the most useful thing it helps me with is helping to see how the price of a stock compares to the fundamentals over the years. You can see right here, price correlated with fundamentals is sort of the main strength of this website. And so on this graph, we have the price chart of the stock going back all the way to 2000, and we have an orange line and the blue line. An orange line represents a PE ratio of 16 in this situation, and the 16 PE ratio is taken from the historical growth rate, which has been around 16%, and using the sort of Peter Lynch formula of price to earnings ratio equals growth, that gives us a 16.5 PE ratio as sort of the historical level that the stock is valued at. And throughout the stock's history, you can see that the price normally tracks the earnings pretty well. So back here, it is very consistently around a 16 price to earnings ratio. Right here, we go into a period of undervaluation where the stock is only at a PE ratio of around 8. And more recently, the stock runs up and is now overvalued in around 2015 with a PE ratio of 26. And now we can see that the stock has just taken a dive lately and is now sitting at $27 with a PE ratio of 8. And the stock pays a 3.68% dividend. They have 14% debt to capital, which is very good for a bank. And the thing I want you to notice is earnings are expected to fall this year, and that probably has something to do with the share price declining over the last year. But I do not think it's something that will affect the company long term, and you can see that the estimates after this year are that the earnings will continue to grow in the future. For Analyst Scorecards, for one year estimates, this company hits earnings 64% of the time and beats earnings 36% of the times, and earnings 2 years into the future only miss 18% of the time. So we see that analyst estimates are historically accurate for this company. Okay, and going on to forecasting. And so if we forecast that the price of the stock returns to the historical valuation of around 15 price to earnings ratio, we can see we have the potential to see a gain of around 64%. Right, and let's take a look at another website. This is Rule 1 Toolbox. This website is the Rule 1 Toolbox by Phil Town. You can get a free trial to this website along with the last website I showed you. And Phil Town wrote a book called Rule 1 Investing, and it was one of the first investing books I read. I highly recommend it to everyone. What I like using this website for is for the historical data. And so we see that this company has great scores. And when we go to history, we see that over the last 10 years, the book value plus the dividend growth rate has been a great 25%, which is awesome. Earnings per share growth over the last 10 years, 28%. Sales growth, 19%. And we also see return on equity numbers are outstanding, and ROIC stand at around 10%. And low level of debt, which is great for a bank. The last website we'll use to take a look at the stock is SimplyWallStreet. I think this is a great website to give the big picture of a stock. What I particularly like about it is the health section, is the section where they analyze the health of a company. So we'll jump right down there for this stock. We can see that long term, they have a very high amount of assets compared to their liabilities. Short term, they have liabilities, which is normal for a bank. A bank, by definition, has a lot of liabilities. We can see that their equity their amount of equity compared to their debt has been growing, which is a good thing. Their balance sheet looks good. And Bank OZK has a current dividend of 3.83, which is only a 28% payout ratio, which is considered very safe. And it looks like there's not really any risk of this company cutting its dividend. So all in all, this is a great company. This is actually one of the stocks I own in my portfolio now. I personally think it's very undervalued. And they have an outstanding management team, and they are growing through acquiring smaller banks, but they're taking it very slowly and not, buying every bank in sight, which I think is a plus. So if you're interested in this company, I would say look into it more. You should read all the annual statements and dig more into the history of the company and the leadership team and its earning reports and so on. Okay, for stock number 2 of this video, we have Mckesson Corp, ticker symbol MCK. They are a medical distribution company. And again, here we see a similar story. And so again, this orange line represents the earnings projected growth at a PE ratio of 15. And this company looks pretty intriguing because you see earnings are expected to grow. However, the company's stock price has deviated from this earnings growth and has seen a fall from $237 down to currently at $142. This company pays a 1.15% dividend. They have 54% long-term debt to capital. And if we look at the Analyst Scorecard, we see for estimates 1 year out, they hit 73% of the time and beat 27% of the time. And for 2-year estimates, they hit 100% of the time. So this is a company with a history of meeting or exceeding analyst estimates very consistently. Forecasting, if we see the price return to the normal multiple of a 15 PE ratio, we have the potential for around 63% capital appreciation. Taking a look at the Rule 1 website, their numbers are okay. Sales are growing. ROE and ROIC, their numbers are outstanding. They have a pretty high level of debt, but overall it seems like they're handling it pretty well. And for SimplyWallStreet, on the plus side, earnings are expected to grow by 30% a year. This website says that the stock is trading at 50% below its fair value. I take the valuations on this website with a grain of salt. They're not always very accurate. And in fact, we can come to financial health. We see that both short-term assets and long-term assets are greater than their respective liability categories. Debt to equity is around equal, and the dividend payments are expected to stay consistent. This is not a stock I'm invested in. I actually don't know very much about this company. All I looked at are the fundamentals. And even though the fundamentals are a very important part of stock valuation, probably the most important part, there's always another side of the story. So if you're interested in this stock, make sure to research it more and get into its history and maybe find out a couple of reasons why the stock price has fell in the last few years. All right, next up is Invesco LTD, ticker symbol IVZ. They are an investment management company, and we see their historical growth rate is around 5% a year. Again, we see that the stock price tracks earnings very nicely throughout their history. When earnings go up, stock price tends to go up. When earnings go down, stock price goes down. And a similar story with this stock, even though earnings are expected to grow slightly, we see the stock price fall from a price of around $36 all the way down to $17. So, even more than cut in half. And the stock pays a very large 7% dividend, and it's partly that large in due to the fact that the stock price has fallen by over 50%. But we can check out operating cash flow, and we can see that this white line represents the dividend, and the dividend is covered nicely by cash flow, and we see that the dividends have grown historically. Check out the Analyst Scorecard. For 1 year estimates, the stock hits 50% of the time, beats 17%, and misses 33% of the time. So once in a while, the stock will miss estimates, but overall, it's pretty accurate. And using the forecasting calculator, if the stock goes back to a normal PE ratio of around 15, we see the potential for capital appreciation of over 100%. Looking at some of their numbers, book value per share and dividend growth rate have been at around 14% over the last 10 years, which is very good. Their ROE and ROIC numbers are okay, with around 9.8% and 5% respectively. Checking out SimplyWallStreet, Earnings are expected to grow at 34.8%. Earnings per share are expected to stay consistent for the next couple years. Debt to equity has stayed pretty consistent, and they have a pretty good balance sheet. And again, coming back to the 7.17% dividend, I'm not a dividend investor per se, but if you are someone who invests in stocks mainly for their dividends, this could be a potentially great opportunity. The dividends have been stable and growing and are expected to grow over the next few years. They have a 96% payout ratio. But again, this dividend is covered by operating cash flow, and we see dividends in 3 years are expected to be covered by earnings. So we can see that these dividends are considered safe and expected to grow. You can also play around with a few other things on this website. We see this shows insider trading. The stock has been bought by individuals in the company in the last year a couple times, which is a good sign. We see the general public owns around 27% of the outstanding shares. There's a lot of cool information on this site that it's worth it to check out. Okay, and for the last stock of this video, and the one I'm the most excited about, we have Health Insurance Innovations, ticker symbol HIIQ. This company is a insurance broker, so they sell insurance plans. However, they do not underwrite the insurance themselves, so there's no risk to them if insurance premiums need to be paid out. And the story with this company is it is a very fast grower, historical growth rate of around 50%. Company isn't very old. They are around 6 to 7 years old, and that we see during the first few years of its life, it traded very closely around this normal PE ratio of around 15. But recently, we have seen the stock fall from a high of 61 all the way down to $22 where it sits today. And I think this stock is a potential excellent opportunity. I recently took a position in this company, and now the story behind this sharp decline in stock price is that there's been a lot of negative press in the company. They've had a few lawsuits filed against them, and they've recently replaced their CEO in the last couple of years. But despite all of this, the earnings are still growing, and earnings are what ultimately determines the future of the stock price. So in my opinion, and most of the lawsuits are settled at this point, however, people are still citing them as a reason not to invest in this company. So looking at the Analyst Scorecard, they do miss pretty often, around 40% of the time they miss their 1 year estimates. However, with the projected 50% growth rate, even if they miss estimates, they're likely still to be growing very rapidly. If we see that if they return to a normal multiple of 15 PE, they have the potential to rise over 200%, which is very intriguing to me. These are the type of companies I like to look forward to invest in. Companies that are only half or a third of what they're worth. I've been just bogged down in bad news, and in my opinion, the bad news is about to start clearing up, and we will see the stock price rapidly increase to around the $60 to $70 level. Okay, looking at it with the Rule 1 website, they also have great numbers. For 5 years, their book value per share growth rate is around 35%, sales growth 44%, and for 3 years, their ROE and ROIC are both around 14 and 12% respectively. They have good debt of only around 1 year's earnings. And looking at SimplyWallStreet, another good tool that this website has is being able to see changes or news events that have affected the company and how it has affected their stock price. So right here, for example, we see that this is when they elected a new CEO to the board in 2016, and how the stock price responded to that. And all these little dots are potential news events you can click on that will show sort of how the story of this company has played out and what resulted in this decline from around $60 down to $20 where it is now. They have a good amount of assets compared to their liabilities, and they do not pay a dividend. This is purely a growth company, and that's pretty much it. So I am very excited about this company and the potential it has for the future. Again, I'm not suggesting you run out and buy all of these stocks. This is merely a starting point. This is merely the first step of stock valuation, looking at the fundamentals. I am only showing you these stocks because they are potentially undervalued, and you should definitely do more research on them if you are interested. So those are the 4 stocks for this video. It should be interesting to follow these stocks over the next few months and see how they perform. So be sure to leave a like and subscribe if you got something out of this video. And keep an eye out for the next video. I'll be posting another one soon. See you then. Bye-bye.